All right, let's talk about a huge shift happening in India's financial world. For the first time in 65 years, the old Income Tax Act of 1961 is officially being retired. And stepping in to replace it is a brand new code, the Income Tax Act 2025. So we're going to dive in and figure out what this really means for you and your money.
Yeah, this is the big question, right? I mean, a law that's been around for longer than many of us have been alive is getting a complete makeover. What on earth does that mean for our taxes? This is a really big deal, and it's going to touch how we earn, how we save, and how we invest. So you're going to want to circle this date on your calendar. April 1st, 2026. That's when we officially step into this new tax era. In this explainer, we're going to break down all the need-to-know stuff, from what's changing for employees and investors, all the way to new filing dates. Let's sit right into it. Okay, first things first, let's get our heads around why this is even happening. This isn't just a few tweaks here and there. Nope, it's a total replacement of the old law, and the new one is all about one thing: simplicity. So, what is this new Income Tax Act 2025? Well, it's the new rulebook for all things income tax, starting from the 2026-27 financial year. And the goals here are pretty clear. The Income Tax Department wants to simplify the language, make it way easier for us to actually follow the rules, and hopefully cut down on all those legal fights and confusion the old act was kind of famous for. And if you want to see just how serious they are about simplifying, just look at these numbers. The old 1961 Act had bloated to 819 sections over the years, with amendment after amendment. The new 2025 Act, it slims that all the way down to 536. And this isn't just about making the book thinner, it's about stripping out all the complicated, layered junk and just using plain, clear language. One of the simplest changes is also one of my favorites. We're finally getting rid of the super confusing terms previous year and assessment year. Thank goodness. From now on, we're just going to call it the tax year. So the money you earn in tax year 2026-27 is what you'll file for. See, so much easier. Okay, now for the part that affects pretty much everyone with a job. Let's look at how all this impacts salaried employees. How is this new act actually going to affect your payslip and what you owe at the end of the year? And let's just get the elephant in the room out of the way right now. For the tax year 2026-27, your income tax slabs are not changing. I'll say it again. The rates are staying exactly the same, so you can breathe a sigh of relief there. So these slabs should look pretty familiar. They're the same ones from the new tax regime, which is still the default option. And remember, the key thing here is that thanks to the rebate, if you're earning up to 12 lakh, your income is still effectively tax-free. So the core structure isn't going anywhere. But, and this is a big but, while the slabs are staying put, the really good news is coming from some major boosts to allowances and perks. This is where a lot of employees are going to feel a real positive difference. And just look at how big these increases are. The children's education allowance, it jumps from a tiny 100 rupees to 3,000 rupees a month per child. The hostel allowance goes from 300 to 9,000. It's incredible. Even things like non-cash gifts from your boss get a 3x increase in the tax-free limit, and the free meal allowance quadruples. I mean, these are changes you'll actually notice. And the good news keeps on coming, especially if you're renting in one of India's major cities. The list of places where you can claim a higher house rent allowance, or HRA, exemption just got a little longer. So it used to be just Delhi, Mumbai, Chennai, and Kolkata, where you could claim an HRA exemption up to 50% of your basic salary. Well, now that benefit has been extended to 4 more major hubs: Bengaluru, Pune, Hyderabad, and Ahmedabad. That is a huge tax-saving opportunity for renters in these booming cities. All right, let's switch gears from salaries over to investments. The new act is bringing in some really critical changes that are going to directly impact traders, investors, and pretty much anyone playing in the stock market. First up, a little heads up for all you traders out there. The Securities Transaction Tax, or STT, is going up. The rate on the sale of futures is more than doubling, and the rate on selling options is jumping by 50%. So the bottom line is, your transaction costs are about to get higher, especially if you're active in the F&O space. Next, let's talk about tax collected at source, or TCS. The big theme here is rationalization, which is just a fancy word for making it simpler. For example, for overseas tour packages, that old confusing system with 2 different rates, gone. It's now a simple, flat 2%. rates for sending money abroad for education and medical reasons are also down to 2%. Now, some rates like for scrap and coal are going up, but the main goal is a much cleaner, streamlined system. Now, this is a really big one for investors. Before, when a company bought back its own shares, the money you got was basically treated like a dividend, so you paid tax on it at your normal income tax rate. Starting April 1st, 2026, that's changing. It's now going to be treated as a capital gain. This is a fundamental shift, and it could actually be a good thing for you, depending on how long you held the shares. And here's a super important clarification for anyone who invests in sovereign gold bonds or SGBs. You know that awesome tax exemption you get on capital gains when the bonds mature? Well, from now on, that only applies if you bought the bonds directly from the RBI when they were first issued. If you picked up your SGBs on the stock market from another investor, you'll now have to pay capital gains tax. Okay, let's wrap up with the practical side of things. Actually, filing your taxes. The new act is bringing in some important changes to deadlines and the forms you use, so you'll definitely want to know about these. And there's some really good news here for small business owners and professionals. The deadline for salaried folks using ITR1 and ITR2 stays the same, July 31st. But if you file ITR3 or ITR4 and don't need a tax audit, you now get an extra month. The new deadline is August 31st. And believe me, that extra month can make a world of difference.
Yep, as part of this whole system reboot, a lot of the forms we've all gotten used to over the years are getting brand new numbers. It's a simple change, sure, but it's something you'll want to get familiar with so you're not confused later on.
Here's a quick little cheat sheet for you. Your good old Form 16, your salary certificate, that's now going to be Form 130. The super important Form 26AS, your annual tax statement, is becoming Form 168. And your investment declaration, Form 12BB, is now Form 124. It's probably a good idea to start getting used to these new numbers. So, to wrap it all up, let's do a quick recap. For employees, your tax rates are the same, but your allowances are getting way better. For investors, watch out for higher trading costs and new rules for buybacks and SGBs. For businesses, you get an extra month to file. And for everyone, we all get a simpler tax year and some new form numbers to learn.
And that brings us to the end. The whole point of this massive change is to make things simpler. So the question I'll leave you with is this. With clearer rules and some really nice new benefits, how will this new, simpler tax code change the way you plan your own finances?